Welcome back to the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week.
Week.
Today we're going to 2129 Southside Boulevard in Jacksonville, Florida, 32216. It's a cash flow positive property, brand new construction, and it can be purchased in your retirement account. You are allowed, Greg, and you're officially back, and you are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the
Week.
I am your host, Pablo Gonzalez. With me, as always, he's back, the man they call GC, not just because he's a championship golfer, but because he's got genius concepts. He generates cash flows, and he's a great co-host, and because his name is Gregg Cohen. Welcome back, Greg.
Well, thank you, brother. I'm happy to be here. Thank you all for being here.
I gave you a little bit of grief about it, but I am happy that you are back. This just feels like everything is right in the world, and it feels right to have the community back. John Henning, good afternoon to you. Bill Shields, buenos noches or dias amigos to you. Marilyn Cotterman from Homosassa, Florida.
Home of the Manatees.
Who was a 72 Dolphins cheerleader. She's saying go Dolphins. She's back. Lee Bishop is back. Andrew Barnhill's back. Nadeem is back. Leo, good morning from California. Bill Shields yelling Duval out here. Who else do we have? Mark Larrett is back.
He's Ben Filson in the house?
Scott Belote is here. Well, you're going to have to wait, man. He might be here. Lou Carlson from Somers, Connecticut. We have not had Jen Filson check in yet, but
oh man, I got to have breakfast with Jen when she's out there. She's from the Monterey Peninsula. So yeah, we got together and had breakfast. And we just chatted about the Not Your Average Investor Show. I mean, she was talking about this community growing, and she wants to create her own community of the show out there. So man, it was, I was with the show, even though I wasn't on the show.
I'm pumped about that. I'm not going to bring up the fact that you didn't send us a picture from that, but I'm not going to say that. I'm not going to say anything about it. I'm happy y'all had a good time. I'm happy she's going to grow a community out there, man. There's some good eating out in the Monterey Peninsula, man. So I'm glad you enjoyed that, and some great golfing. I heard you had a couple really good rounds, but that's not what the show's about today, Greg. The show is about our community, and this is a community-driven show. So that being said, go to right now, whatever you're doing, go to jwbinventory.com. and you're going to be able to download the spreadsheet that we're about to fiddle with, right? So we're going to be looking at this property. We're going to be fiddling with the numbers, and you get to play right along with us at home if you go to jwbinventory.com. And even if you're listening to this later on and you want to play along with us, you can go to jwbinventory.com. It should be there for you. Greg, before we get into the property, we've got a little bit of an update on the sales process these days. There's if you haven't tuned into the show, there's an extraordinarily high demand for rental income properties because the market is historically good for it. And that means that you've had to adjust a little bit on the sales side of how you're bringing on. You want to tell us a little bit about the lead times going on?
Yeah, absolutely. It's really been a theme that, for really probably the last 6 to 12 months, we've been talking about the changing market, right? Interest rates being so low, the fact that we do expect higher than normal home price appreciation in the coming years because supply is so low, inventory is so low. And what I've really tried to do on the show is to just be transparent and give you guys a heads up of things that will change either within the JWB landscape or across the entire landscape of rental property investing. So, that dialogue really continues. Inventory is challenging at this time. And, JWB has a lot of inventory. We have a lot of land that we've developed over the years and a lot of land that we've still haven't developed. But one thing you need to actually develop land, even if you own it, is you need the building department to issue permits. And so we talked about that challenge, 3-4 months ago. And really at that time, what I said was, I would expect there to be some slowdowns in the amount of inventory that JWB can provide really temporarily because, the rate of sales that we have is 2 to 3 times what we've had in past years. And if you can't build as fast as you want, even though you own the land, you can't get those permits to come through, then it's going to slow things down. So that's really the update today. Things are slowly but surely coming through as far as permits from the building department, but it takes a while before once those get issued before we're actually going to make it available for sale. There's usually about a couple of month window. So that's really the update. Things continue to be progressing. They're slow. And the big takeaway for all of you out there who are buying rental properties is that JWB does have existing inventory right now. We do have a ton of demand from new clients coming on board and from existing clients. So your timeline, as far as how quickly you can actually purchase, if you were to call today, will vary based on how many clients are currently purchasing and how many permits are released from the building department. Right now, it's going to be somewhere around 3 weeks to maybe 6 weeks. In normal times, when the time for you coming on as a new client, it usually is about 2 to 3 weeks. So you're looking at slowly but surely those timelines are going out, maybe 3 to 6 weeks, as I mentioned right now. And we use that time, those 2 to 3 weeks, for a normal client onboarding, really to kind of get to know you and to build your plan anyways. So it's going to be a slow process. There's going to be a little bit more of a delay just because of kind of the nature of things right now. But the good thing is that we do have existing inventory for all new clients coming on board, and and that certainly won't change.
Awesome, man. Must be nice to be sitting in the position of actually having in the inventory when everybody else that's in this game is like a year out doing waiting lists for people and stuff like that. Do you is the sales team hearing that? Like, is everybody else on a wait list when they're getting on? Are people surprised that you have inventory?
100%. People are shocked, and actually what we've been hearing for new clients coming on board, we've never seen this before, but people are reaching out and they're saying, hey, listen, I just want to kind of get to know who JWB is. I want to put my name on the waiting list right now because I'm not expecting to be in a financial position to buy for 12 months from now. And that's a new thing for us. We have never experienced that in the past, that people have been so proactive. It kind of creates another challenge for us because when we're working with clients and bringing them on board right now, we have existing inventory that can be purchased right now. So we politely let them know, hey, listen, this is great. You don't have to be a year in advance to start talking and starting that process, because we do have inventory available for you. It's a matter of weeks rather than a year in advance. But people are so conditioned right now whenever they call other shops, that they have to get their name on the waiting list and then they have to wait a year. So they're sort of kind of trying to plan their financing in that time frame. So we don't have to worry about that. But it's a real challenge on the acquisition side and new construction side for our business. We have really been going strong and really been challenging our team to acquire as much as we can and to get the new construction projects going as much as possible, because when you've got 2 to 3 times the amount of demand to purchase properties, you want to be able to fulfill it. So
I get it, man. I feel like I don't know what movie it is, right? Where they're talking about like peacetime versus I don't know if it's The Godfather, because I don't really know those movies that well. They're talking about peacetime versus wartime consigliaries. I feel that JWB has been kind of preparing for this moment for a long time, and it's like this is where all the the excellence in execution and everything that JWB has been doing for a long time kind of pays off. So I put in the chat to go to jwbinventory.com so that you can follow along as we show this property, which is active inventory right now, right? Greg, I don't know, is this, we'll talk about whether or not it's available, but as of right now, we are whisking away to 2129 Southside Boulevard, Jacksonville, Florida, 32216. And this is a new construction home listed at $285,000, 4-bedroom, 2-bathroom, 2-car garage, estimated rent range between $1,675 and $1,750. And what we always like to talk about, we're going to talk about a couple of other of these, but we generally get into this part right here first. This estimated conventional financing, total monthly cash flow of $142 per month, and this estimated conventional financing total ROI of 7.19%. Greg, you're back in the hot seat, man. Let's talk let's talk about what we normally like to explain to set this up. And I want to encourage anybody that has questions about the inventory, about this home in particular, start putting them into the Q&A so I can start interrupting Greg as soon as possible. But Greg, what does the total monthly cash flow number represent?
So that $142 that you see there, that really reflects what is so beautiful about rental properties, that it's an asset that pays for itself every single month, right? There aren't a whole lot of investment options out there that you can buy, right? You can invest in it. You can take out debt on it, and the income from that asset pays for all of that and then some. And that's the most beautiful thing about rental property investing. That's what being cash flow positive means, right? And when you hear the term cash flow positive, what that should mean to you is risk mitigation, right? It's an asset that pays for itself, which means that it's bringing you income every single month, no matter if the market value of that house goes up or goes down. It's paying for itself every single month. And the other thing it should communicate to you is that this is a scalable asset class. You know, if you've got one asset that's paying for itself, but your goals dictate that you need to have 10, that next asset, that second asset continues to pay for itself. Third asset continues to pay for itself. 5, 8, 10 assets pay for themselves, which is a beautiful thing if you're trying to ramp up in any asset class, and especially in rental properties, because you don't have to go negative in the hole. And if you went in the hole every single month to cover the mortgage payment, the expenses, you know, how much worse would that be for you if you had to get to 5 properties or 10 properties to accomplish your goal? So that $142, that's what it communicates to me, kind of big picture. It's that it pays for itself and that it's scalable. You know, specifically the way that you get to $142 is you're looking at what happens on a normal month for a JWB rental property. So you've got your rental income that comes in, and we take out your normal expenses. So that would be your principal payments, your interest payments, your property taxes, your property insurance costs, and your property management fees. Those things happen every single month. So you take the rental income, as I mentioned, you take out all of those expenses, and you're left with that $142 a month estimated in this case here.
There you go. I love how you describe it, right? Like and your language has evolved, right? Like to talk about like the scalability of this, but it lands so well every time you say it, as far as just the idea that as long as whatever you're doing pays for itself, the next thing that you add to it, you don't need to subtract from Peter to pay, you know, Paul or anything like that. And you can just continue stacking these assets on top of each other. Greg, we've got officially our first question. No surprise. Lee
Let's do
Bishop, MVP of the Not Your Average Investor show and star of last week's show while you were gone. He writes, 285K is high for the range that's usually that JWB usually has, and rent at 1724 is a lot to ask for the renters JWB normally sees. Is this property going to be tough to fill, or is it one-off and so in demand by extended family structure?
Great questions. The $285,000 purchase price actually is right where the median home price is for Jacksonville now. So as the market has appreciated over the past year, specifically, and really over the last 10 years, prices have risen. We want to be in that below middle income to middle income type of range. So the easiest way to define that is look and see what your median home sales price is, and that's probably middle income. So this is right there. 285 is basically what the median home sales price is across all of Jacksonville, and that's reflective of this property as well. It's kind of getting closer to middle income. Same thing with the rents. So 1725 is what we estimate. And your question as to, is this too high for us to be able to serve our normal renter? No. You know, we have homes that are that below middle income, getting to middle income type range. And we're really comfortable being there. This is in the South Side, which is, it's the name of the street is South Side Boulevard. South Side is also one of our 4 key neighborhoods. So we're not going outside of the normal criteria or neighborhoods that we want to be able to be in. Within those 4 neighborhoods, sometimes you have more below middle income, and sometimes you have closer to middle income. And so that's what this home is. It's closer to middle income. So I have no concerns with our ability to rent this home out. This home actually is available right now, which is unique. We haven't had a home that is available for purchase on our show in quite some time. So that's really exciting. The home is not built yet, though. If you guys see the fine print under that picture, as I was just talking about how challenging it is to be able to have new construction, be able to meet the demand that we have for purchasing it. New construction is typically being sold right now to clients when it is usually about 3 to 4 months away from actually completing the build. So that's the way this home is on South Side. This picture that you see is the exact model of the home when it will be built. Of course, we build the same models over and over and over again. So this is that exact model. So it is available for purchase for anybody, current clients, new clients, friends of the show here. And I have no doubt that we'll be able to rent this one quickly as we do. I'll give you some renting stats that are just insane, right? We have just over 3,800 homes on the market. And we have about 45 we have 3,800 homes that we manage. We have about 45 that are on the market, but I did a little digging because I knew that that number was actually higher. And what we actually do internally now is if the number of homes that we have available to rent actually becomes too low, we start to do a little bit of kind of showing the homes in advance so that we have homes to market. And so out of those 45 homes that we have available on the market right now, there's about 13 or 14 of those that are actually haven't even been completed yet. We only do this when the inventory gets extremely low for available homes to rent. So this renting market right now is really hot, just like the market is for investing in turnkey rental properties. Our average days on market to rent out homes is somewhere around 12, maybe 15 days on market to rent a home right now. So I have no doubt that we'll be able to rent this one quickly. It's right within our wheelhouse, and just kind of goes to reinforce what an amazing time it is to be in rental property investing at the moment.
Have you guys ever had to do that before? Have you ever had to
It's never been this low.
start renting
Well,
stuff
I
so
probably
aggressively?
shouldn't say. I mean, we manage 3,800 homes now, right? When we were managing 100 homes, we had less than 45 on the market or whatnot. But for the percentage right now, I mean, we have over 99% occupancy right now. And the numbers actually even get better if you took out the number of homes that we just built or just renovated, those just hit the market, haven't had a chance to rent. If you took those out, your stabilized occupancy is actually even higher than the 99%, right? You probably take out half of those homes on the market that way. So the renting stats have never been better. And I like to think we're pretty good at what we do here at JWB. I know we're pretty good at it. And that's a real credit to our team. But I also want people to know that this is a function of this asset class right now. It's a function of there not being a lot of supply, both for homes to rent as well as being homes to purchase out there. And so if you're in rental property investing right now, you're riding a very positive stream, right? You are going with the flow down the stream right now, which is a great place to be as an investor.
All right, man. And we got a great question here in the Q&A, which is where we're going to go next, from Teresa Carrillo. Good to have you on board, Teresa. She says 142 monthly cash flow does not include vacancy reserves and tenants placement fee. And is the base 25% down? So monthly cash flow will be at a lot less if down payment is 20% in the year that tenant placement fees apply. Greg, why don't you explain to Teresa what the difference is between total monthly cash flow and this number over here, total ROI, and then we can play with the 20 to 25% down on the spreadsheet. And Teresa, I recommend you go to jwbinventory.com and get the spreadsheet so you can go in and do the calculation with 20% down versus 25% as we're warming this up with the explanation. Go for it, GC.
And Pablo, I got to say, first of all, Teresa, great question. Thank you so much for being a part of the show. And Pablo, I love how you're like getting into the question too, and putting some emphasis on this too. I like this. Let's make this happen every single question.
If you want me to overperform, if you want me to theoretically ask the question more often, if that's what you're asking, yes.
I think we should. You should do it in different voices and different theatrical elements, if we could. So first question, Teresa noticed that the $142 does not include maintenance and vacancy costs. She is 100% correct. What you want to do is you want to make sure that this asset cash flows positive on a normal month, right? And that's what we show with that $142. A normal month, you don't have maintenance and vacancy costs, right? That's not a normal month. You want to make sure that on a normal month, you're positively cash flowing. But you also need to make sure you take maintenance costs, vacancy costs, and other expenses into account. And that's where that next measurement is, this total return on investment. In this case, it's 7.19% as an estimated return on investment. That's why you also need to make sure you look at that. If you only look at that $142, that total monthly cash flow is very myopic. You're only looking at the cash flow, but there's actually 5 profit centers in rental property investing. And to make things simple, we include 4 of them, and all 4 are included in your total return on investment. Okay, so the way that you calculate your total return on investment is you take your rental income, you take out your principal, your interest, your taxes, your insurance costs, just like we did before. You take out your property management fees, but you also take out your tenant placement fees, and you take out the full burden of the tenant placement fees. For those of you who are maybe new to rental property investing or experienced and have invested with other rental property turnkey companies out there, it's very common that they don't include the tenant placement fee as a cost, or they only take a percentage of it. We take all of it because that's what you're actually going to see in the first year. So you include that expense. You also include maintenance costs and vacancy costs, because they're not going to happen every single month, but over time, over the years, they need to be accounted for there. And when you're thinking about your total return on investment, you're thinking about long term, over time, how is my money going to perform? So we do include maintenance and vacancy costs there. You take all of that, and then you divide that by you annualize that number, and then you divide that by your initial investment. And your initial investment is your down payment plus your closing costs. If you do all that, that's how you get to that roughly 7.2% estimated return on investment. And the next question, I think, was about the down payment, right, Pablo?
Yeah, there was a down payment, but I'd like to clarify, right? So as you're explaining that, it's this idea that Teresa was kind of like calling out, right? That 142 is just your typical month throughout the life of the investment, right? That's most months you're going to make $142, but she is 100% correct. There is other times that you have something happen that's not the case. And that's why we break down the two numbers of that, or the ROI, which includes all the 5 profit centers, except for one that we'll talk about in a second. And yeah, the second question that she asked was about what happens with the cash flow. I'm rephrasing at this point, right? But what happens with the cash flow with 25% down versus 20% down? So first question was, this is assuming it's 20%, 25% down, and she is 100% correct. If you go to this analysis conventional financing tab over here, we have it as 25%. Right. And interest rate assumption of 4.13, which I have recently just closed on a property that had less than that. But JWB makes sure that you got a number here that you're definitely going to be able to hit. And with that 7.19% ROI, but I can just as easily go into the spreadsheet, put in 20% and see what happens. Let me get rid of this weird thing over here and see what happens. The total ROI actually goes up, and to Teresa's guess, the cash flow, in fact, does go down a little bit to $73 when you do 20%. Greg, you want to talk about the difference between putting down 20% versus 25%?
Yeah, absolutely. So, you should think of yourself as your own financial engineer, right? How can you use all the tools and resources to give you the best risk-adjusted return on investment? What we're seeing here, Teresa just dropped her percentage down from 25% down to 20%. That means that her denominator just went down, right? That means that the money invested in the deal just went down. So when you're thinking about your return on your investment, if you have less money in the deal and keep all things constant, keep all things the same, then your return is going to be higher. So when she put less money into the deal, that means that she has a higher loan balance. So when you have a higher loan balance, that is going to increase your monthly payment on your loan balance. So what happened was she was able to decrease the amount down. She increased the amount of the loan. There's a higher payment each month for that loan, which decreases her cash flow. So your cash flow goes down when you put 20% down, but your return on investment actually goes up. It actually went up, and that is somewhat new for many investors. So if we are thinking about it solely from a return on investment perspective, most of the time, 20% down is going to equate to a higher return on investment than 25%. The reason why we put 25% in our standard evaluations is because we're conservative. This is my answer for a lot of questions. Why do you put these numbers here, Greg? Why do you put these numbers here? It's because we're conservative. We care so much about when you guys come on board as a new client, we want to show up 2 years, 4 years, 10 years down the road and actually hit that return on investment calculation that you signed up for. And so you're going to see elements of that through our evaluations, all throughout the evaluations. But yes, it is something that we talk about with you. In your client onboarding, you would sit down with my team and we would build out a plan for you. And as a part of your buying plan, we're going to talk about whether 20% down is right for you or 25% might be right for you. We're going to have this plan in place. You're going to know exactly why you're doing it. And so that's how we help clients make that decision.
Yeah, there you go. And, to add context to that, right? Like I recently went through my first 2 acquisitions in the first 6 months of this year. I put down 20%, Greg, because at the end of the day, I know that I'm in this thing long term and I'm trying to acquire as many assets as possible. So I'm putting 20% down, understanding that as long as it's positively cash flowing, it's scalable for me. And it's that the monthly cash flow isn't the game that I'm in as much as long-term ROI, getting into this Jacksonville real estate market. Like that was what was most important for me. So I wanted to get in as soon as possible. And because of that, I'm comfortable, right? Like otherwise, if what I really, really wanted was to maximize my cash flow, I would have gone 25%, I would have paid cash, whatever, right? Like it would have been a completely different equation for me, but both of those things worked. And another thing to note is if you put 25% down, I think right now mortgage rates are slightly lower. The money, the cost of money is a little bit less, whereas 20% it went up like point something percentage as well. Something else that I experienced.
There's typically a small difference between putting 20% down versus 25% down. At the end of the day, the bank views it as they take on less risk by you putting 25% down. So they're going to give you a slight decrease in the rate if you put 25% down versus 20%. But one of the cool things is if you get this spreadsheet, if you go to JWB Inventory, you can adjust all of this. And, most of the time, even taking into account the fact that your rate is going to be slightly higher for 20% down, you're still going to be able to see your overall return on investment expectation actually be higher. So you have lower cash flow, a slightly higher rate when you put 20% down most of the time, but your expected return on investment is still higher, which is interesting. That's the value of you putting less of your own money in the deal. Going from 25 to 20% allows you to put less in there. And, if you're thinking like an investor and you're making decisions based on your best estimated return on investment, that would lead you to 20% in that example. And then a whole lot of other reasons why, right? In an appreciating market, it's better to have more assets that you have, that smart leverage on being at 20%, because the value of your appreciation goes up a lot more when you have, a certain number of assets at 20% versus less assets at 25%. There's an incredible amount of, there's incredible benefit to being diversified just in managing your flow of cash. When you have 3 properties, that's going to be consistent. When you only have 1 property, well, that property isn't rented, it's not going to be nearly as consistent. So a lot of very big benefits to go 20%. A lot of clients do that.
Cool. And another interesting thing is I understand that I pronounce any name that's of Hispanic descent. I think about it in Spanish and I pronounce it. But Greg, I like how you're keeping up. And I don't know if Teresa goes by Teresa or Teresa or however she does, right? Feel free to correct me in the chat. Greg follows my lead, and I like your, you have a Honduran wife, man. So I know that you're well versed.
I can hang.
I met your in-laws. All right. So we got another question here. Gerard Wendling has a question. What expenses are there for a buyer on a pre-built home after closing and before the home is completed and rented?
What expenses are there? Nothing.
That's easy.
So let me give you a little bit more context there. Great question, Gerard. And it's not always that way when you're buying from another company, and definitely not if you're buying from buying properties the normal way, let's say through a realtor and whatnot. When you buy this home, it will be built. So what happens is, Gerard, you put the property under contract with JWB now, and then in 3 to 4 months, the house will actually be built. So from that point, when it's put under contract until you actually get to the closing table, you're going through your typical loan, right? You'll have loan fees that will show up actually at the closing table. Typically, that's about 2.5% of the purchase price. And that's built into this evaluation as well. So you have your typical closing costs and your loan costs. You'll have an appraisal and things of that nature. So that's all there. You get to closing, that's all paid for, right? At that point, the home is completed and actively rented or actively close to being rented. And you don't have any costs in between the time when you close until when the house is built, because the house has to be built by the time you close. You know, when that house is rented, which should be on your closing date or very close to it, then you would have fees that come along with tenant placement. Tenant placement equals your first month's rent. That's what we earn for placing the new resident in your home on a long-term lease. And then when the house is rented, we earn 10% of the fees as your property manager. So, but I think the question was specifically, what cost do you have from the time that you close on it to the time that the house is built? You don't have any costs because the house is built before you close.
There you go. So 0. Lee Bishop with another question. This house is septic and yet maintenance rate is 4%. And I see that there is no fee for the septic insurance. How is that going to work out for the investor in the future?
Great question, Lee. So and what Lee is referencing is that if you look over past episodes of the Not Your Average Investor show, specifically for the property of the week, you'll see homes that are renovated as well. We have renovations and we have new construction. And what we have seen over time is that if there's a renovated home and it's on a septic tank, what we've actually done is tracked. Since 2011, we've tracked every dollar in and every dollar out for every type of home that we have. And so we've seen that renovated homes that have septic on them actually have a higher maintenance expectation than other homes. So it's actually 9% if it's a septic home that is a renovated home. And how do we get that information? It's all data driven. We have this incredible data flywheel. Pablo, I knew I was going to get a smile out of you when I said data flywheel.
I love the data flywheel.
We have this incredible data flywheel that we created over 10 years ago, where we basically, as I mentioned, have tracked every dollar in and every dollar out. And we use this to a client's advantage to make sure we set the appropriate expectations for maintenance costs. You're not going to see that in any other turnkey provider that I'm aware of, actually having that data flywheel and using that and preparing clients in advance if maintenance costs are going to be higher. As I mentioned, on a renovated home for a septic home, it would say 9% there. So Lee's question is, well, Greg, this says septic, why is it still 4%? Well, that's because that's what the data tells us. So we actually have all that data from all of our new construction homes that have been built as well. And we've been able to see whether that is septic or on city sewer, and been able to see what those maintenance rates are. And the data shows us 4% there. So we don't have to distinguish between septic and sewer for new construction. So that 4% there is going to be consistent for all new construction homes based on the data. For renovated homes, you'll see slightly different maintenance numbers. It'll be 9% for septic and it'll be 6% if it's on city sewer.
Awesome, man. And Lee Bishop writes in, that is a great point that JWB keeps records to help the investors. And I totally agree. Like every time you say data flywheel, I smile, and to let everybody in on the secret, that is something that like Silicon Valley tech companies base their business around. Right. And it's out of this concept of the Jim Collins book, Good to Great, where he talks about building your business off of a data flywheel as a competitive advantage. So I'm always just like enamored with JWB's business model. That's the inside joke. Nothing to see here. Just a big fanboy. All right. So Q&A. Gregory Stone asks, in the current, Gregory, thank you for putting this from the chat to the Q&A so that I don't mess it up. And here comes your payoff. Gregory Stone asks, in the current environment, if a property is currently rented for $800 on a turn this year or next, what do you expect the rent to be? So I kind of put the commas in the wrong place. But if a property right now is $800 on the next turn, do you think you're going to jack up that rent? Is basically what he's asking.
Rents are rising really quick, Gregory. They are rising really quick. So I've seen some data out there support Jacksonville's rents have risen 8% year over year. You know, generally rents rise at that kind of like 3 to maybe 4% range. Kind of like same thing as home prices over the long haul, and very close to inflation. So when you hear terms like rental properties are a hedge against inflation, what they're talking about are rents and home prices rising kind of in line with the rate of inflation. It's hard for me to put a number on what that would be. I mean, if you use the 8% number there, right? So 800 times, that's 10% would be $880, so come down a little bit from there. It would be based on that, 8% number that I got from John Burns Real Estate Consulting, which is a really well-respected consulting firm that we pay a bunch of money to every single month to get that type of information. You can't hold me to that, but rents are rising. Rents are rising really quickly. The thing to keep in mind, though, is that we are always going to prioritize long-term resident stays, because many people get enamored with what their rent rate is, and they fail to realize that if you go so aggressive with your rent rate that you only sign a resident who's only going to be there for 1 year, you're gonna end up losing in that equation, because if they turn over that property in a year and you have to put $3,000 into that property, maybe even 4 or 5 if you start to count in the vacancy cost as well, then it wasn't really a smart move for you to maximize rent, by an extra $25 a month, only to give $3,000 back at the end of the year. So keep that in mind. But we are seeing rents rise really quickly. So could it be up, to 850? Could it be up even higher than that? I think it's very possible. But just don't get too enamored with rent rates. Rent escalations and rent increases, as well as signing 2 and 3 year leases with a company that also focuses on renewals of those leases, that's the winning target.
There you go. Long-term relationships. So you see that everywhere in the JWB ecosystem. David Gray has got a question following up on Teresa's question. I understand the 5 profit centers, but with a relatively low expected free cash flow, is there a way to balance that with larger expected benefits from the other profit centers? Or stated differently, how would you compare this property with other properties available for purchase?
Wonderful question. I think this is a great time to talk about those other profit centers in a little bit more in detail, right?
I agree.
All right. So let's zoom in there too, Pablo. So we've got this total return on investment of 7.19%, right? The way we get there is we take into account your net cash flow, right? That total monthly cash flow, that $142. But we're also taking into account the maintenance costs, the vacancy costs, the tenant placement fees. What we're also doing is we're adding in your tax savings and your principal pay down. So those are 2 additional profit centers there. So you take all of that together and you divide it by your initial investment, and that's how you get that 7% return on investment, 7.19% in this case. There's another very large profit center that we haven't accounted for here, which is, I think, what the guest, and can you remind me who asked the question?
David Gray.
David, great question, right? So what David's asking about is, what are the other profit centers? And he's looking at that $142 and he's saying, that's not going to change my life. What else would be a reason for me to be able to invest in this? Well, we're gonna take a look at that here in a second. That 4th profit center that we haven't accounted for yet is home price appreciation. And the reason why I'm such a big proponent of smart debt is because when you mix smart debt on an asset that pays for itself, that also is poised to go up in value over the long run, you really start to see this investment shine. And you haven't seen it yet because we haven't put appreciation rates in there yet. The way to think about home price appreciation is, don't get too enamored about what it's going to do 1 year to the next, because you need to be investing for the long haul in order to count on home price appreciation. Reason for this is because if you look over the history, real estate cycles tend to repeat themselves, which means that home price appreciation rates, if you go out long enough, tend to repeat themselves. And if you look over 10, 15, 20-year segments over time, you're going to find that your home price appreciation rate is going to largely match what it was historically. So in Jacksonville, the historical home price appreciation rate is 4.3% per year. And if you're an investor today and you wanted to buy this house on Southside, and you're planning on holding for the next 10 to 20 years, you can count on that same home price appreciation rate over the long haul, right? That's roughly 4.3% on average year over year over year. That's what it has done since 1991. And again, real estate cycles tend to repeat themselves. So that's what you can do. When you do put 4.3% in there as an expected appreciation rate, it is going to skyrocket your total return on investment, which, Pablo, Johnny on the spot, perfect on the timing there, brother. That's what we have there, right? It jumped it from about a 7% return up to a 23% return. So David, your question's really spot on. A lot of times when people look at a rental property investing evaluation, or even think about rental property investing in general, they say, oh, geez, it's only going to cash flow $100 a month. why am I doing this? Why don't I just go and put my money in the stock market? And I feel like they're missing the boat, right? In the stock market, the all you're thinking about is appreciation. You're buying it at this amount and you want the stock value to appreciate to this amount. And that's what you're betting on to make this thing work. You don't get positive cash flow. You don't get extra tax savings. You don't get principal pay down. You don't have a hedge against inflation many times as well, built into the investment. So in the stock market, you're just banking on home price appreciation. In rental property investing, you've got an asset that's paying you every single month, right? But to me, that $140 doesn't change my life. It's probably not going to change your life. That's not the reason to get into rental property investing. It should be paying for itself every single month so you can hold on for a full market cycle so that you can take full benefit of all of the profit centers. And when you take the full benefit of all of the profit centers on an annual basis, your return on investment is somewhere around, over 20% in this case. So, David, I hope that shined a little bit of light on it. It's a really common question in the thought process. So I appreciate you asking that. And I know it's on the minds of a lot of folks out there.
For sure. I love this. I love this trick that we always do of this showing when appreciation hits the smart debt and how that, inflates the return. And that was a really missing piece of something that I didn't understand until we did this 40 times on the show. And now I really, really get the power of leverage. The other thing that I've learned recently, Greg, is the idea that, yeah, this $142 won't change your life, but you're playing for this cash flow, right? Like at a certain point, you're going to pay off that property. And then this is the actual cash flow, right? So now you're making 1178 once you pay that thing off, which will happen by itself because it is a scalable investment at some point, or it could happen sooner based on things that we've done on the buying plan.
You're 100% right. I love that you just pointed that out right there, right? Because when you're building your buying plan with my team, we're going to break this thing down into the number of assets that you need to have in your portfolio. And it's really the minimum number of assets that you need to have in your portfolio. A lot of people don't know how to build a plan to buy rental properties. The right way to do it is to build it as if you're going to buy a minimum number. And the reason that you do that is because you want to understand how many assets are going to be required in order to give that cash flow on a monthly basis that's going to hit that monthly goal for you. If you start to go into buying the maximum number of assets that you could by using financing, all that good stuff, it tends to be less valuable for an owner. So what you do is you build a plan, and many times you build it based on financing, looking at what your return on investment can be. But we've got that first milestone, which is based on the number of assets that you need as if they're owned free and clear. So when Pablo's talking about how he's making a decision based on using financing as a return on investment, that's how he's making the decision about how to buy. But when he's thinking about building his entire portfolio, he knows at some point they're going to be fully paid off. And that 1178 of monthly cash flow is more reflective of what this property will actually perform for him at some point.
There you go. Another trick that I've learned recently. I'm glad we got to apply that. I'm going to go back to the regular 0% so that we are keeping consistent. And we got a couple of great questions coming up here. Mark Meisberger asks, will this property be on the septic maintenance program? If so, what is the monthly cost? There was a septic maintenance program that we described. Greg, maybe you can catch everybody up on it and let them know if it's going to be on it.
Yeah, the septic maintenance program is a huge, huge benefit for all of the new construction properties that are sold with JWB now. So this is an example of, over the years, JWB coming up with really creative ways to be able to limit maintenance costs and vacancy costs. And as we looked over the years, what were the biggest drivers of maintenance costs? They were, like a septic tank going bad. It's a pretty expensive item to fix. And so we looked at what are those line items that are most expensive and how do we mitigate the risk of that? Well, what we did is we came up with our own septic warranty program. And we worked with our vendors to be able to make this agreeable for everybody. And the cool thing is that this property would fall under the septic agreement. This means that if there was an issue with the septic tank, that it is under warranty and that the vendor will actually replace this at their cost, which is huge. Right, this is really, really a big deal for you if you're buying a property and you have a septic tank. on it. So yes, this property is there. And from a previous question, Lee asked about the fee. So what happens is the vendor is going to earn a monthly fee for a warranty that they're going to hold on it. And the beautiful thing is that included in this fee is they have routine maintenance that is included as a part of this fee. And of course, it makes sense for them over the long haul for them to be earning a monthly fee, which would cover if one of the septic tanks went out, they would be able to cover that. And that's how they'll, of course, make money, but also serve you as a client. So there is a fee involved with this septic warranty. You don't see it on your evaluation because guess who pays that fee? It's
Who,
not
Greg?
you. It's not you. It's not me. It's not Pablo. Your resident actually pays the monthly septic fee. And here's why it makes sense for them too. Because if you are a resident and you are on a property that has sewer, you pay a monthly fee in terms of your utility cost to JEA, the utility authority here, to be able to maintain the sewer. And the same type of thinking is why it makes sense for a resident who is on a septic tank. They pay a monthly maintenance warranty fee for the septic tank to make sure that their utilities, their septic tank is in good working order. So it comes out basically the same net effect to the residents. We're able to find a win there for the resident to be sort of the same out of pocket as if they were in a sewer property. It's a win for the warranty vendor because their goals are aligned. They are incentivized to make sure that your septic tank is in great working order. And then if something does happen for you as the owner, you're not going to get hit with that big bill because it's under warranty, and that septic vendor is going to be able to honor that warranty for you. So a really cool example of a win across the board.
I love it. And another good example of how just JWB doesn't just operate as a innovative rental income property company. You innovate as a property management company, right? Like you are always looking for the ways that you can optimize the experience as a property manager, which is fantastic. Is that program available to property management clients that aren't rental income investors?
Well, it's for any property, any new construction property that is purchased.
Okay.
So if we have clients that we do the turnkey properties for, meaning that they buy the turnkey properties for us, right? That would be included for those clients. We also have clients that we just do the property management services for. And so if you're somebody out there who already has rental properties and you want JWB to manage your properties for you, JWB can do that for you. If you were to purchase a home with us, then we'd call you a turnkey client at that point. So yes, no matter who is purchasing the home for this home on Southside Boulevard, that warranty is included for anybody.
Cool. Great question here by Miguel Angel Sanudo that I've been wanting to get to because I think I'd love to know this answer, right? But he asks, I see this property is nearly 300K. Do you think from a risk perspective, that would be better than to buy two of 150K instead?
Do I think it'd be better from a risk perspective? No. I don't think that you have a higher risk profile for this property at 285,000 versus a higher risk profile at 150,000. And the reason is because we stay in the same core neighborhoods. We're attracting the same type of residents. I mean, there's a relatively small range of residents that we serve. And of course, your biggest risk mitigators is how well the home was constructed or renovated, and then how effective your property management is. So all of those things are the same. The one thing that I would think is a benefit if you had the opportunity to buy two properties at 150,000 is that you're on your way to a diversified portfolio. So, right, your return on investment shouldn't change over the long haul if you have one property or three properties or 10 properties, but your cash flow situation can. And so from a risk perspective of having kind of cash flow swings, it's always better to have multiple properties in your portfolio rather than one. If you only have one property and the home isn't rented, which will happen at some point, there's no other property income to offset that loss that year. It's going to be a bad year for you. But if you have three properties in your portfolio, that's really the target number that we work with clients to get to in a relatively short period of time. That number is three because generally speaking, you have two properties that are doing well at any point in time, and you generally have one property that has some sort of an issue to it. And those two properties buoy the property that has some sort of an issue with it, and your cash flows remain largely consistent there. So no difference in the risk profile for this property versus two at 150, largely because the variables are within that small range that we stick to over and over and over again. Better way of saying it is we're not going to go elsewhere outside of our model, outside of our core neighborhoods, because if we did that, we would involve some additional risk. Even if we went too high for the price ranges, or if we went too low, different types of risk, but there would be more risk there. So this is right in that range there. However, if you have the opportunity to buy a lower priced asset and get in so that you can buy two and be on your way to three of those, I think that's a real difference. The challenge is right now, Miguel Angel, there's just not a lot of low priced inventory out there. If you look over, especially the properties of the week over the last few weeks, we have seen a lot of new construction. Kind of lets you guys know that we were going to see a turn towards more new construction over, that was probably 2 months ago. I kind of let you know that this was going to happen. When you see a lot of new construction, your price points are going to be higher, right? Your price points are going to be kind of at 200, maybe up to kind of middle income here, 285,000. So, the opportunity to get in at 150,000 for your purchase price is just really not possible very often. And I was just looking at the inventory that we have available right now, and there's not a property that's under 200,000 that's available right now. And that's just the way of things. It's going to be that way going forward as you see more and more new construction, because new construction is the only way to serve you all inventory at the moment. There's just not enough existing inventory out there to be able to serve clients and make the numbers work.
Makes sense, man. Really well explained. Miguel Angel has another question, and he says, is the homeowner insurance cost real in this evaluation? Because he's seen them skyrocketing lately.
Yes, this is very real. So every insurance cost that you see on this evaluation has already been quoted by our insurance team. And so we're not going to put something on this evaluation until we know it's real. You have heard a lot about insurance costs going up, and there's a lot of rumblings right now about insurance costs coming up. It's something that we're keeping our pulse on. But the important thing for people to know is that, a lot of the price increases that have happened actually happened really about a year to two ago. So if you look over the last year or so, home prices, insurance costs on our evaluations haven't jumped that much in the last year across the board. And if you go now, there are some potential big news out there that could happen in the future that could adjust this. You're hearing rumblings of insurance carriers pulling out of the state of Florida. We're just waiting to see what happens there. I'm not going to get overly excited about all that news at this point, because I don't know where that's going to land. But what I can tell you is that insurance costs have been low in the state of Florida for a long period of time, and then costs went up largely about 1 to 2 years ago. And really wasn't much of a noticeable change there, especially because cash flows are still positive, returns on investment are still positive, and overall insurance costs are still pretty low. One additional thing to add there: new construction is largely a different conversation when it comes to insurance costs. So the big source of a lot of the rumblings on the insurance side is that, man, I don't know how to step into this one without, getting into the legalese of it. But, a lot of the insurance companies are basically kind of sectioning off what they're going to cover. If your roof is over a certain age, they may not cover it like they used to. Or if your plumbing is a certain age, they may not cover it like they used to. So that's a lot of kind of what the changes are going on right now. And I don't know exactly how that's going to land. But none of that really applies to new construction. So your new construction is largely insulated right now from a lot of what's going on from an insurance perspective, which is great, because we see a much larger percentage of JWB assets going towards new construction in the coming years. The cool thing, though, is even for your renovations, we're going to have an insurance premium that is based on whatever is going on at the market right there. So if the numbers work for a renovated home with an insurance cost that is based on what the market can provide for you right now, then there's not a reason to be afraid of renovations as well. There's just just a lot going on as far as the insurance market. So we're going to let it calm down a little bit.
All right, there you go. GC, we got about 5 questions open right now. It's 1:26. How you doing on time, buddy?
Let's rock and roll. Let's knock it out, man.
Let's rock and roll. Nadeem Shah is ready to rock and roll with you. He says, when is the loan application made before the construction or when? Sorry, let me start over. Nadeem Shah says, when is the loan application made? Before the construction or when the house is nearing to be completed or a new construction loan is taken and after completion, it's changed to a 30-year loan?
So let me just kind of walk through the timeline. If Nadeem was going to buy this property today, Nadeem would put it under contract with our team. So Nadeem would put the binder deposit down and the home would be reserved for Nadeem. And let's say that the home's not going to be built for 3 or 4 months from now. Let's just say 4 months, just to use a solid number here. Nothing's going to happen with the loan for probably, 2.5 months, right? Because what we don't want to do is get Nadeem started in a loan, lock you in for an interest rate, and have no chance of actually being able to close that home before your rate expires. Then you'd have to extend it and pay more money to do that and all that good stuff. So Nadeem puts it under contract today, let's say for 2.5 months. It's a waiting period, right? There's nothing that's going on. We're not going to do the loan. When the time is right, my team and our lending team would work with Nadeem to decide when that time is right. Let's say it's, at the 2.5 month mark, then we're going to start the loan process. And at that point, we'd get you locked in for the rate. And then your loan, may take, call it 3 to 6 weeks to close the loan. And that 4-month time frame is really dictating when the house is going to be done. That's dictating when we're going to close the house, and then we're going to start the loan process. Call it somewhere around maybe 6 weeks prior to that process. And that's how it would go.
There you go. Marilyn Cotterman asks from Homosassa, Florida.
Home of the manatees.
I signed my new construction home contract on March 9th, and the home wasn't completed yet. Expectation was it would be done end of April, then end of May, and now end of June. My great rate was 3.375% was locked in until June 21st. So it may lapse and may have to lock in a higher rate, or it may go down. What do you think the rates will do in the near future, up or down?
Well, first of all, Marilyn, sometimes that happens with new construction. So appreciate you sharing that experience. That can happen. We try to, of course, get the build done on time, but if anybody's tried to build a home before, it can be a challenge. It's even less under our control than a renovation. So it's just one of the challenges when you buy new construction, that it may get pushed back. Do I think rates are going to go up or down? Everything I'm reading is that the Fed is not in a hurry to raise rates. They are comfortable with a certain amount of inflationary measurements happening before they are largely going to increase rates, is what I'm hearing. But at the same time, rates are so low. So I don't think they're going to go lower. Do I think that they're going to go higher in the next 60 days? I really don't know. But I think over time, this is going to be a race to acquire your interest rate at whatever you can get today. Because 1 year from now, 2 years from now, you're going to see a sharp increase. And the thing about it, what many people aren't factoring in is you talk about $142 of monthly cash flow, and that might be a relatively small amount. Well, if you go to JWBinventory.com and you actually get the evaluation so you can play with an interest rate, it doesn't take much of an interest rate uptick to completely eliminate that positive cash flow. So once interest rates start going up, it is going to go up and the cash flows are going to come down in a hurry. So I don't know if that's going to affect you, Marilyn. I think you're probably in a good spot. I don't think rates are going to go down anymore, but my guess is that you're probably going to be in a good spot for the next 30 days or 60 days. But overall, everybody, if you're thinking about this asset class and you're somewhat on the sidelines, but you really want to be investing in it, you should be doing your due diligence now, because once rates start going up to 4.5%, 5%, which they're going to go back to that over the next coming years, the cash flow opportunity is going to be a fraction of what it is today.
Yeah, man, for sure. Well, Gregg, I know that we teased the idea of buying this in your in your retirement program. So I want to hit that before we move on to anything else. And we're getting an assist from our guest that's joining us again from France. Anonymous Attendé asks, if purchasing through a solo K, do all the fees get paid out of the solo K funds? Does one need to maintain 6 months of reserves? So Gregg, maybe you can talk about this whole non-recourse financing and how you purchase one of these properties in your retirement account.
Yeah, absolutely. Thank you so much for the question. Buying properties in your retirement accounts for many people they're completely unaware of it. Some people are convinced you can't do it. But there is nothing wrong with buying properties in your retirement accounts from an IRS perspective, from a retirement account perspective. It is totally fine to do it. The reason that you haven't heard more about it is just because your typical custodians, right? Your Merrill, your TD, Ameritrade, your Fidelities, they don't allow you to do it. And that's where your typical retirement accounts are housed, right? In your company 401ks, you generally are not going to find an option to invest in real estate. And so many people have come to the conclusion that you can't do it. But that's not the case. I have done it. I do it currently. I also do private lending out of my retirement accounts. And there's no rule against it. What you have to do is just find a custodian that allows that investment option for you. And of course, we have relationships with some of those custodians. So if you need help finding one, just reach out to my team and we'd be able to help you do that. But once you find a custodian who allows you the opportunity for your IRA or your solo 401k to invest in a property, it's the same exact process of choosing the asset as if you were buying a property with JWB outside of your retirement account, right? We go through the client onboarding, we build your buying plan, but we make some changes as far as what your financing options would be. And one of the changes is that your normal conventional financing options that you can get outside of your retirement account they are very different than what you can get inside your retirement account. Many people don't understand why this is, but your conventionally financed properties, at the end of the day, if you have a conventional financed loan, like on your primary residence, if you have that loan and you don't make the payment to your bank, the bank can take the property back from you, and they also damage your credit for 7 years so that you can't go and buy a house, or it makes it harder for you to buy anything else because your credit's ruined for 7 years. In your retirement account, there's no social security number for your retirement account. And so by default, there's no ability to have that type of recourse to damage the credit of a retirement account. So if a lender is going to lend to that retirement account, they know that they're only going to take the property back, and they don't have that additional recourse against you if your IRA decides to not make the payment. So because of that, there's almost zero lenders out there. It's a very small niche of lenders out there who want to be in this game of making loans like this. Of course, we have a relationship with non-recourse lenders. So again, if you'd like a connection and if you think this is right for you, reach out to my team, schedule a time to chat with us, and we can make that introduction for you. But because of all of this, your terms are going to be not nearly as good as conventionally financed if you're doing what's called non-recourse financing. You should expect 50% down, 50% down, and your rates will be somewhere around 7.75%. And so it's a different type of evaluation that you go into for your retirement accounts, but it is possible for you to purchase in your retirement accounts. And I thought what we do is just spend a few minutes talking about why that would make sense for somebody to be able to buy a property in their retirement accounts, knowing that those interest rates and those terms are not as advantageous. How did I do there so far, Pablo?
I think you're doing great.
Okay.
You're doing great. Are
cool.
you are you moving into the why it's advantageous to buy?
Yeah, I thought I would. I just want, I know with the question, I think I already forgot the question. So you'll have to remind me if I didn't answer it. That's really where I'm going.
Let me check it out too. You had me hypnotized too. It is, do all the fees get paid out of the solo K fund? So you answered it, right? Like does everything get paid out of the solo K? Yes, it's all contained inside your retirement account. And does one need to maintain 6 months of reserves within the retirement account? I'm not sure if you answered that.
So yes, all of the fees come from your solo 401k, all of the money to purchase or to handle any maintenance costs or whatnot. It's very important that that integrity of that account stays true. So yes, all the fees would come from your solo 401k. All of the rental income will go back into your solo 401k. So as I mentioned, that is critical. The reserves, you typically need more than 6 months of reserves in your retirement account. And the reason is because if you get to a place where you have a big expense, but you don't have the money in your solo 401k, I don't have a good solution for you. There is not a good solution out there. Your property, in essence, just has to sit until you can get money into that solo 401k, because you cannot make a contribution from yourself personally. So that is a very big concept that we talk about with investors who are buying in their solo 401ks or their retirement accounts. Generally speaking, you only have a limited amount that you can contribute to these retirement accounts every year. And if you made that contribution and you used all that money to invest in a rental property, and then a maintenance cost happened and you didn't have any money to pay for that, like, there's not an answer. There's just not a good solution there. Your property just has to sit. So, and then your resident is not in a good spot, and this could really break down. So you need to have more than 6 months in your solo 401k to be able to invest properly and wisely. And again, to know exactly how much you need, that's a conversation we have as we're building out your buying plan for you. It's obviously a different answer for every investor, depending on how much you have in your retirement accounts, where your assets are. So I would highly encourage you to reach out to my team to get to that answer. Did I answer everything there?
I think so, yeah.
Okay. Well, cool. So let's zoom into the non-recourse financing. Summary of returns there. Because a lot of times we don't spend any time here, and I don't feel like non-recourse financing gets any love from us. So I thought we'd just talk through this, right? You're looking at this and you're saying $102 a month in cash flow. Okay, that's cool, right? $100 a month. We know that it's supposed to be cash flow positive. So, it's not 142, but it's close enough. But you're looking at your total return on investment is 0.39%. And you're saying, well, Greg, why would you ever advise me to buy something when I can earn a 0.39% return on investment? Okay. Well, think about what this return on investment calculation is taking into account today, right? It's taking into account your net rental income. Okay. Normally, what it would take into account is your tax savings, but there's not additional tax savings when you invest in your retirement account, because no matter how you buy in your retirement account, you're already getting the tax savings. You don't get additional tax write-offs of depreciation for being in your retirement account. So you're missing out on that profit center, that tax savings profit center. You do get your principal pay down profit center, which is great. So that helps there as well, but it's not taking into account home price appreciation. And it's also not taking into account the fact that you have a limited amount of capital that you're ever going to be able to get into your retirement accounts. What I mean by that is, we all have day jobs out there, right? If we get a huge promotion or a big bonus, or if we get this great inheritance for some reason and it goes into our personal bank accounts, at that point, we could go and invest that and buy 100 rental properties. Well, in retirement accounts, you have a limited amount, right? It might be $6,000 that you can contribute this year. No matter what, if you struck it rich and hit the lottery, you're still only contributing about $6,000 into your IRA. For a solo 401k, it's more, but there's still a limit there. So you have a limited amount of assets in your retirement account. And if your goal as a financial engineer is to maximize your return on investment, you need to look at ways to use leverage to be able to do that. In retirement accounts, because you have this limited amount of assets that you're going to have in your retirement account at any one time, I think about it in terms of how many properties can I get that will deliver positive cash flow when fully paid off. So if you're in the mindset of an investor who's thinking about using non-recourse financing, here's the thing. You've got a limited amount of money in your retirement account. At the same time, cash flow for you is really low on the priority list. Pablo, why do you think cash flow in your retirement accounts is relatively low on your priority list?
You can't use that cash until you retire.
That's right. Right. If you got $100 a month or $300 a month or whatever, you're not you can't touch it, right? If you touch it, you take it out, then you're going to pay withdrawal fees on it, which wouldn't usually make sense for you. And you've got maybe $100 or $300 coming in a month in this example that I just created. There's not a whole lot of investments out there, especially in real estate or in, private lending or anything non-traditional, that you're going to take this, $1,000 a year and go and make another big investment, right? Like for me, in my retirement accounts, I want my money working as much as possible for me. And if I have an extra $100 a month coming in, I can't really do anything with it. I'd probably take it out of that retirement, custodian's retirement account and go and put it somewhere else, right? Where I could invest in a bond or stock or whatever, right? A mutual fund. Like you just can't do a lot in the non-traditional asset space. So cash flow is really low on the priority list. But what's most important for me is if I only have enough to buy one house with cash, if I can buy two with financing, at the end of that loan, I'm going to have two assets that are each positively cash flowing maximum amounts for me. So it's about maximizing the number of assets with a limited amount of capital, more in your retirement accounts than it is outside of your retirement accounts when you have more opportunities to infuse capital. And the last thing that it's not taking into account there is home price appreciation. If we were to add that 4.3% appreciation rate there, you'd see it would jump up close to 8-9% as far as your total return on investment. So if you look over the long haul and over all 5 profit centers there, your return on investment is really strong. Again, you have to be in for the long haul. And if you're going along with what's the most important thing to you, cash flows very near the bottom. Diversification is really important, and then long-term returns are still really strong, over 8% there. That's why a client would choose to use non-recourse financing.
Got it. Well explained, Greg. Makes sense to me, man. Greg, I'm gonna wrap it up here, but I got a couple like quick hitter questions. Andrew Barnhill asks, how much do you have to put in to contract on the home to get a contract on the home with JWB?
So 25%, and this is something you can find, Andrew, and actually, Pablo, if you go to the analysis conventional financing tab, we can give them a real answer there. But anybody can go and get this evaluation, and you'll be able to answer this question for yourself as well. At 25% down for a $285,000 purchase price, if you go to the right there a little bit, Pablo, you'll also want to include closing costs. So in closing costs estimated for us are about $7,125 here. So you're looking at about $78,000 out of pocket for this property on Southside.
Okay, there you go. And is that, so when they say contract on the home, I read that as like to put JWB normally takes a deposit, right?
Yeah, sorry. There we go. Screwed that one up. Yes. So if you're a new client buying your first property with JWB, the initial binder deposit is $5,000. If you are buying your second, third properties, if you're a repeat client with JWB, then the binder deposits are only $1,000 for every additional property.
Got it. And yeah, Andrew was talking about holding the new construction before the loan. So yeah, so $5,000 as a new client, Andrew. And once you become a repeat, it's a little bit less, right? Like it was a little bit less for me for my second time around. And I think we'll leave it there, Greg. I think there's a couple more questions. I encourage everybody to ask these questions inside the group. Join us at jwbfacebookgroup.com, right? Like we got our investor group of almost 3,000 people. We're trying to get it there. So if you have a friend that's interested in creating wealth, invite them in. And Greg goes live in there often. And we like to hang out in there in between the shows. So we hope to have you there. And again, if you like this stuff, if you want to get in on this house, you want to put a deposit down on it, or the other inventory that JWB has, which is available to new investors and existing investors alike, go to chatwithjwb.com. Just pick a time on Courtney's schedule. It is a very enjoyable process anytime that you're interacting with anybody at JWB. I compare it to like going to an In-N-Out burger where just everybody you've ever interacted with is super helpful, super happy, and they're really, really good at their job. So it's always a value add proposition. Last but not least, we never take it for granted that you took an hour out of your busy day to hang out with us here on Thursday's Not Your Average Investor show. So thank you for the bottom of my heart. Great questions that kept us long. We love doing it to add extra value. GC, good to have you back from Pebble Beach, and I will leave it to you to close us out.
Thank you, brother. Thank you, everybody, for being on the show. It's just amazing, the community and the group that we have. It gets better every single week. So I'm excited. Next Tuesday we have an incredible show with one of our clients, Tim from Oregon, out on the West Coast. And when I think about Tim, I've known Tim for many years. Super knowledgeable dude. And I remember the moment that he sort of kind of got this model and has really gone really strong into it. So I'm really excited to hear Tim's story. I think you all will relate. But Tim lives in a place in Oregon where home prices are way high. And he wanted to get into this asset class, but couldn't do it in his local market. And he, didn't know JWB from anybody, did an online search and came to know of us, and now has built a really robust portfolio. So if you're in that same spot and you haven't met me and you haven't met Pablo and you haven't met the team yet, but you're sort of interested, it'll be great for you to hear the real life experience of another client who's been super successful. So hope you'll join us on Tuesday, and I hope everybody has a great rest of the week. We'll catch you next week. Thanks, everybody.
Adios.